Hello, everyone. This is Bill Seeger from Corporate Education in the College of Business. I am sorry for the delay. This is our first webinar of the series, and we, as you can imagine, have experienced some technical difficulties. But with my great team, we think we have a solution. Unfortunately, Kevin Kliesen will not be live in person, but we'll have his voice here soon. So I'll be able to interview him, and we'll be able to take stock of all his great information. So we're just waiting for Kevin's voice to pop in here, and we'll begin, and we'll still end at 2 o'clock. Why don't I go ahead and tell you a bit about Kevin and our webinar series. As I said, this is the first in our series of webinar broadcasts related to economic and business impacts of COVID. And our first guest is Kevin Kliesen, who's a business economist and research officer at the Federal Reserve Bank of St. Louis.
Kevin Kliesen
may be coming in
joining
just now.
Yep.
Kevin, are you there?
I'm here, Bill.
So sorry, and I appreciate your patience. I guess it's the first broadcast difficulties, and I can't thank you enough for your patience. And I wish we could have your face and your visage. We're just going to have to settle with your great voice here and all your tremendous ideas, if that's okay.
Yeah, we'll make it work, Bill.
Yes, we're can-do folks. So, Kevin, I was just with a little bit of that dead air introducing you as you came in, and was prepared to tell people that you are at the Federal Reserve Bank of St. Louis. We know each other because we're colleagues in the organization of the National Association of Business Economics. We have done some limited work together. And that's how I reached out to you to be our inaugural guest here on the webinar series. So you're a business economist. You're also a bank officer in the research division at the Federal Reserve Bank of St. Louis. You joined the bank in 1988, and you have a master's in economics from Colorado State University. And, as a business economist, you analyze current U.S. macro and financial market developments and trends for the bank, the president, and staff economists. And this is important prior to each Federal Open Market Committee meeting. So you are front and center in your role right now in terms of providing input, as necessary to the Federal Open Market Committee. And, as a business economist,
I can see you, Bill.
Oh, good. We're getting a little lag there.
So I'll just keep it on the phone.
Yeah. Okay. Great. Yeah. Just keep it on the phone. So the thing I wanted to mention next is that you are a research officer, and I just wanted our listeners to know that the Federal Reserve Bank of St. Louis is renowned for its research. That's a well-known fact among economists, and so we're really thrilled to have a research officer, or the research officer from this famous Fed bank with us today. So thank you, and thank you for your patience. And I'll begin these questions in a moment.
Okay. Well, just want to thank you, Bill, and the University of Texas at Arlington for arranging this event today.
And thank you very much for being here. So we'll get right to it. Kevin, the question I get a lot, and I wanted to pose it to you, is how does the pandemic, the crisis, first the aggregate supply shock and then the aggregate demand shock, how does this differ from the 2007 financial crisis, which I presume you had a integral role in advising. So how do these two things differ?
Well, Bill, first I want to remind everyone that I'm speaking for myself and not my St. Louis Fed or Federal Reserve colleagues. So when you're in the Fed, you have to give that disclaimer. So I think to begin, there's several resemblances and guess and hence the similarity of the responses by the Fed and fiscal policy makers. So if you look at some key financial indicators, comparing this episode and what we saw in the global financial crisis, we saw this time big declines in equity prices and yields on government securities. We saw a lot of volatility in stock and bond markets and rising interest rate spreads. One of the things that we look at is the St. Louis Fed's Financial Stress Index, which we actually developed in 2007, and it spiked and it rose sharply, and that's kind of what you see when these market-based signals are occurring during an episode where there's a lot of uncertainty about the health and future performance of the U.S. economy. Our financial stress index did not rise to the same level it did in 2008, which was kind of interesting. And, it peaked in mid-March and it's since come back down and it's now something much closer to normal. So financial markets seem to be normalizing, but clearly we have not seen that with the real economy.
Yeah, for our listeners, in terms of my next question, in terms of the tools the Fed has used to date to deal with the pandemic crisis, I guess you could say there's been a backstopping of the economy and being a lender of, last resort. These are generally well-known functions of the Federal Reserve, are they not?
Yeah. I mean, the actions the Fed has taken, whatever view you have, are certainly consistent with the mandate that Congress gave us when it passed the Federal Reserve Act back in 1918, and there's obviously been subsequent amendments. So that's basically the guidelines that we operate under. Obviously, to be lender of last resort, to try to stabilize financial market conditions to the best we can using the tools available to us. And then there's also this special provision in the Federal Reserve Act, which I'm sure you know, the so-called 13.3 section, which allows us to work with Treasury to devise other sort of special lending facilities that may have that may reach certain parts of the financial markets that our traditional tools do not.
On the lender of last resort, is that, for the U.S. economy, or is there a special preserve for the Fed to assist other economies as well?
Well, we do have the ability to basically provide dollars to other central banks through what's known as our swap facility. So basically, we are exchanging dollars for example, if we engage in what's known as a swap operation with the Bank of Japan, we're taking yen and we're giving them dollars, and they're using those dollars to help their banks or financial institutions who do cross-border business in dollars. The Fed does not bear any exchange rate risk in those arrangements. So they're basically ways for the Fed to help foreign economies through foreign central banks.
Has there been anything out of the ordinary in that channel of activity, let's say relative to 2007? Is there anything there as a leading indicator of how foreign economies may view the future?
Just based on the swaps activity, or I guess.
I mean, are a lot of governments trying to swap their currency for dollars, or is it pretty stable at the moment?
Well, the Fed has has opened up swap lines. I don't know if the volume at this time is the same as what it was in 2007. I'd have to go back and look at that.
Okay.
But again, I think I would just make the point that the Fed is engaged with foreign central banks, not foreign governments.
Oh, I'm sorry. Thank you for the clarification.
Yeah.
Yes. So I wanted to get to tactics with regard to the crisis. And we understand what the government, or at least we've had the press on what the government is doing in terms of its 4 phases. So what specifically have been the tools of the Fed in response to the crisis? And I've been hearing a couple of different thoughts. One, we hear the term quantitative easing, helicopter money, as well as discussions about the possibility of negative real rates or negative interest rates if banks have to borrow reserves from the central bank, if I have it right. But I wonder if you could just talk about the different tactics the Fed is using to combat, this loss of confidence in the economy.
Yeah. So I guess one of the things I would stress is that this situation is much different from 2007, 2009, and I think in one key respect, and that is kind of the first order economic effects this time stem from planned government policies in response to the COVID-19 coronavirus that effectively put a large swath of the economy. Coma is maybe too strong a word, but clearly there's a large segment of the economy that's really not operating at the level of activity it did before the crisis. So that has had significant blowback effects on the economy. So given the Fed's congressional mandate, the Fed really couldn't sit on its hands and do nothing while financial wealth was evaporating, unemployment claims were skyrocketing, and sales and production were plummeting at rates last seen since the 1930s. So the tactics that the Fed adopted this time around are much the same as in 2007, 2009. So one of the first actions, obviously, was to move to cut our policy rate effectively to 0. And then we started to ramp up purchases of Treasury securities and mortgage-backed securities. That's the kind of traditional quantitative easing part of the Fed's program that it has undertaken now, which it did then. So that increased the size of our balance sheet. So that helps to provide stability to financial markets. And then we did some other things. We reopened a lot of the special facilities that were put in place during the financial crisis. And all of those have greatly increased the size of our balance sheet. The Fed has also encouraged the biggest banks to borrow from the discount window. And we temporarily suspended some regulatory requirements for both large banks and community banks. What distinguishes the current episode in terms of tactics from the earlier episode is that several new lending facilities were implemented this time in conjunction with the Treasury. And these are the facilities that were enacted under the Section 13.3 part of the Federal Reserve Act. So in these special programs, the seed money was provided by Treasury with funds that were allocated under the CARES Act that was passed in late March by Congress and signed into law by the President. So, things like providing liquidity to primary and secondary corporate bond markets, the Main Street Lending Program for smaller and mid-sized firms, and the Paycheck Protection Program liquidity facility for small businesses. And there's also a facility to backstop municipal and state government borrowing. So a lot of these things that the Fed has done now, it did not do back then. So it's really ventured into some new territory.
What has been, or let me get to just briefly to consumer sentiment. What is your view about consumer sentiment at this time. Have all the programs or the strategies and tactics you've described, including the new instruments, I'll call them, that have been employed, do you think that will have an impact on consumer sentiment, so that people will be encouraged to get out and spend and invest, or are we going to be in, as they say, that the Keynesian liquidity trap, where there's all kinds of liquidity available but nobody's borrowing?
So Bill, if one of the things I do is I track kind of a daily consumer sentiment index, and clearly during the worst of the panic, and basically from mid-March to mid-April, consumer sentiment was plunging. So that was kind of consistent with the idea that there's a lot of uncertainty among consumers, and they're not quite sure, is the business they work for, is it going to shut down? Are they going to get laid off? So there was a lot of fear in the market. So how consumer spending patterns and business operating procedures change in the aftermath of this COVID-induced social distancing, I think, are some of the key questions that forecasters like myself are facing. I think another key unknown, obviously, is the extent of permanent job losses and business bankruptcies. And if we begin to see kind of a wave of business bankruptcies, that's probably also going to put a further dent on consumer and business confidence. So I think the good news is some of the high frequency indicators have kind of bottomed out, and they've turned up a little bit. So again, it's I don't think we're at a point yet where obviously where people are back to normal, given the fact there's still large parts of the economy where the shelter-in-place restrictions are still more restrictive. So it's just going to take time for this to sort of return to normal. I think if there is widespread testing and a proven vaccine, I think that will go a long way in sort of returning to kind of a more normal environment for consumer psychology.
So I want to follow up on your point you just made, and would you, in your view, are we in a recession from a strict definition, the economic definition of 2 quarterly declines in GDP, that sort of definition, and have we been in it for a while, as opposed to we may have just gotten into it?
Yeah. So so clearly the arbiters at the National Bureau of Economic Research, which make this determination, have yet to weigh in. On the St. Louis Fed's website, we have something called FRED, which many of our users might know about. FRED is the world's largest free database of economic statistics. And one of the indicators, or one of the recession gauges that we publish, currently has a 100% probability that the economy was in a recession in March. So that seems pretty convincing. And then when you think about sort of the horrific numbers we had in April with the employment report, nearly 21 million jobs lost, the unemployment rate rising nearly 15%, and it seems likely that labor markets will contract further in May, and the unemployment rate could rise to 20%. So I certainly think the numbers suggest that we're in a recession now. I guess the key question, though, is the duration. If you look at the National Bureau of Economic Research records, they date the shortest recession on record was actually a 6-month recession that began in January 1980 and lasted till July 1980. So if we are in recession, it could be fairly short, but it certainly seems to me anyway that given the level of job loss and the likely plunge in economic activity we're going to see in the second quarter, that we're in a recession.
So Kevin, if I could, let me have you gaze into the crystal ball, and I've got a couple questions following up on your comments. One, if the recession ends, that will mean the economy will, or GDP will grow. However, that doesn't necessarily imply that we're back to the peak, let's say, of January 2020 before the crisis hit. So just broadly, because you're looking at the data, and this is, and you have tremendous insight. When do you think the recession will end? You mentioned maybe it'll be short, but then when do you think we'll get back to the peak? Let's say January 2020.
So, obviously, we're in the middle of a crisis, and uncertainty is very high. So it's extremely difficult, if not impossible, to forecast with any degree of accuracy while we're in the current environment. I think there's a couple things you have to look at and think about. So many states like Texas are loosening their shelter-in-place policies, and we're starting to see some green shoots in economic activity. Hotel bookings are starting to pick up. Airline passengers moving through airports are starting to pick up as well. So we're not yet doing high fives over the data, but clearly there is some upturn in activity, and I think that's important. Another thing to keep in mind is that other areas of the country, and I'm thinking particularly about kind of the most populous and biggest metropolitan areas on the East Coast and West Coast, areas that produce a lot of the nation's GDP, are loosening restrictions at a much slower pace. I read a report yesterday that Los Angeles plans to keep its shelter-in-place policy intact for another 3 months. I mean, that's so if that pattern becomes widespread among these big metropolitan areas, it's just going to further slow the pace of recovery in the second half of 2020. So I think that the consensus of private sector forecasters is that the level of GDP will probably return to its peak sometime in early 2022. So that would be a little more than 3 years later. Now, if we compare that with the financial crisis in 2007, 2009, we didn't reach the peak until more than 4 years later. So hopefully this time around, the speed with which we return to the peak is going to be shorter. But again, it's just hard to tell right now.
So currently, and we appreciate the insight you provided on what I call, let's say, short run tools and tactics available to the Federal Reserve during the crisis. But as we talk to our students about in economics, we always say economists think about the long run as well. And I wondered if I could turn your attention to some long run type of questions in terms of effects from these shorter term policies that you've articulated. And I wanted to start off with quantitative easing and making credit available to the banking system and to consumers and businesses, et cetera, as you described. But I guess long run, what about, or I wish you would give us your view on, first of all, inflation. People have asked me, are we going to have a hyperinflation now? Because we've all grown up with Milton Friedman, and when we're printing money, we got to worry about inflation. And then secondly, this debt financing and long-term growth. Is there going to be some impact on long-term growth? So if you could tackle those, I'd appreciate it.
Yeah. So these are pretty much the same questions the Fed faced last time around in the financial crisis. Obviously a key question during the crisis and coming out of the crisis was, will this supersized balance sheet lead to higher inflation? And not only that, how fast can the balance sheet be unwound? So those questions, I think, are certainly very appropriate. And but again, given we're in this period of massive uncertainty, and the economy is basically in a disinflationary economy, and the Fed is still increasing the size of its balance sheet, that those questions are, I think, pretty difficult to answer right now. Now, what we do see is that money growth is increasing very rapidly now. In March, M1 and M2 are up by double-digit rates of growth from a year earlier, and that's fast. But I would just remind you and our audience that M1 growth actually hit a peak of nearly 21% in August 2011. So, if we saw those kind of money numbers back in the 1970s, obviously that would not have been good for inflation expectations. This time around, 21% money growth really didn't elicit much more than a yawn. I mean, the FOMC announced that it was implementing a 2% inflation target in January 2012, and even since then, it's been very difficult to hit its 2% inflation target. So, maybe this time will be different. We don't know. One of the things that we're looking at pretty closely is if you look at market-based measures of inflation expectations that are embedded in long-term Treasury security prices, it doesn't appear that holders of those bonds are too concerned about higher inflation going forward. But the Treasury is issuing debt at a pretty rapid pace, and the Fed is still buying a lot of Treasury debt, and that's taking it on to its balance sheet. So it's possible that markets could become spooked if it looks like money and credit growth is accelerating at a very rapid pace, and if that happens, you could see inflation expectations begin to increase. So if that scenario develops, and I don't think that's our baseline, well, for me, I know it's not my baseline forecast at this time. It's going to be important that if it develops, that the Fed will have to get in front of that to prevent inflation expectations from becoming unanchored to the target. I think one of the things that's benefited the Fed is that it's established a lot of credibility with the markets, and if that credibility begins to erode, then that's really when you get concerned about inflation expectations beginning to pick up. But so far, at least, based on prices of Treasury securities and surveys of inflation expectations, we're not really seeing that.
Well, thank you. Another long-term concern, and related to your comments just now, is debt overhangs in the long term. Economists or some of the research I've read about discuss the debt overhang. Two choices, or maybe there's three, but two. Either we have to have long-term growth or austerity, where governments fiscally are going to have to cut back in order to deal with the debt. So anyway, your comments on that.
Bill, are we talking Treasury debt or publicly held debt?
Yes.
Or corporate debt? Okay.
Yes.
Yes. So as you mentioned, there's some options. One obvious option is to raise taxes. And the Social Security Trust Fund trustees issue an annual report every year, which basically says to close the funding gaps, payroll taxes have to rise by X percentage points. So that would have a significant drag on on longer run growth. The other option is to cut spending. Doesn't seem to be a lot of appetite for that right now. The other option is to basically default on the debt. That I don't think anybody wants to do that, and I don't see anybody seriously mentioning that. And then the other option is to inflate it away. That's the option that a lot of third world countries have done, where basically they're engaged in what's called financial repression, where they're basically forcing their central bank to buy the debt they're issuing, and by doing so, they begin to generate large growth rate in the money supply, and that just fuels inflation higher and higher. Mm. So, at some point the debt has to be dealt with. I guess one way to think about it is the debt that's being raised now is going to have to be paid for in the future with higher taxes, and or some combination of higher taxes and reduced spending.
You mentioned the one option an option that third world countries have engaged in has been, inflating the debt away. I wanted to ask you if your view of if third world countries, are the seed of our next crisis on the heel of the pandemic. That is, with no ability to really issue sovereign debt, will the next crisis for, I don't know, the G20 countries be propping up developing countries? So right after we deal with COVID and maybe get our own economy stabilized, are we going to have that kind of emerging market third world country crisis?
Yeah, it's possible. I mean, when there's financial crises, these emerging market economies or even less developed economies tend to struggle more so than advanced economies. One of the great benefits of the U.S. is that the dollar is the world's reserve currency. So, everybody wants to hold dollars, and the only country that can issue dollars is the United States. So that gives us what's been called an exorbitant privilege. So that allows us to do a lot of things. I think one of the institutions that was implemented after World War II to sort of help the advanced economies and less developed economies through some of these problems is the IMF. So I would expect that this would be kind of the first option for many economies that get into trouble is to go to the IMF for some sort of special
loan. Kevin, your comments have been very clear and down to earth, and I thank you for that. And I wanted to end by asking you to summarize, the takeaways our listeners should take from your comments, and then after that, we'll invite the audience to put in some comments through the chat box with Mike Woolman. But if you would, what are the takeaways you want our audience to take from your discussion?
Well, I think first of all, we're in this very difficult situation that really is very unusual. It's mostly, I'd say the first order effects of the decline in activity and the high jobless rate is because of planned policies to sort of deal with this healthcare crisis. So it's very, very unique in history. We haven't really seen anything like this before. That is the response to the pandemic. Mm-hmm. The Fed has responded very aggressively, which basically is consistent with its congressional mandate. The Congress and the administration have also responded very aggressively. So I think there's a lot of stimulus in the pipeline that can help offset some of the damage that's occurring. But I think the worry is that the longer we see these shelter-in-place policies persist, I think it greatly increases the likelihood that you'll see, just waves of business bankruptcies, individuals who are going to find it very difficult to reenter the labor force because either their skills may have eroded or the firm they work for went out of business. So I think we need to think about some of the costs as well as the benefits from some of these policies and sort of think about how we sort of begin to restart the economy so that we avoid this sort of depression type scenario I've outlined.
Well, thank you very much, Kevin. Your remarks have been tremendous and very clear. And I wanted to ask Mike Woolman if we have any questions from the chat box. I'll turn it over to Mike.
Oh, sorry.
Oh, there we go.
All right. Thanks, Bill.
Trying to read your lips.
Yeah, I know, right? Live captions. First off, I just want to say thank you so much, Kevin, for being a part of this today. I know you've been a huge trooper with our technical issues that we had at the beginning of our first webinar here. But your insight that you've provided today, I think, is of great value to so many that have kind of registered and been a part of this, participated in the live event. Some of the questions that have come in during the interview have mainly been about being able to access this recording so that they can go ahead and absorb the information that you've shared. Some have asked if they could put their questions anywhere in any kind of an area where you may be able to respond at a later time if they formulate some questions. Is that possible at all that people submitted questions?
Yeah, or they could do that, or they could go to my website, Federal Reserve Bank of St. Louis, and my email address is there. They could always shoot me an email.
Okay.
I answer email, so happy to do that as well.
Okay, great. But as of right now, we had about 5-6 questions that came in. They got answered. In the meantime, they were more towards the beginning of our event today. And so we don't have any follow-up unless anybody that's attending right now. We have a handful of folks that are part of us. If you want to go ahead and utilize that live event Q&A, please do submit your questions if you have any.
And while we wait a minute, I'll ask Kevin just briefly, because we may get a question. What research are you working on currently? Your personal research?
So a colleague and I just were trying to finish a draft of a paper that goes back and looks at the so-called monetarist Keynesian debate in the 1979-82 episode. This is when Chairman Volcker came in, switched to basically targeting money, and that was kind of a revolutionary change for the Fed, and that's really what helped bring down inflation that rose to double-digit rates in the 70s and early 80s. So we're going back and looking at the FOMC transcripts and sort of getting a flavor of the debate between Chairman Volcker and the president of the St. Louis Fed at the time, Larry Roos. So that's kind of what I'm doing right now.
Great. Mike, any questions?
None at this time. Are you currently working from home, or are you guys going into the office? And do you have any upcoming speaking engagements or anything that you'll be participating in that people can register and attend as well?
I do have a couple of speaking engagements next week, but I think those are mostly by invitation only. I don't know if there's. I mean, they are to the public, but I don't know how somebody could get an invitation to it, frankly.
Very good.
So yeah, it's a challenge. I enjoy the personal interaction with people and meeting people and talking to them when I go out and give talks. So this is a little bit different, and hopefully it won't last much longer. But we all have to adapt, right?
Sure.
For what
Right.
circumstances are.
So, Mike. Oh, sorry, Kevin. I didn't mean to cut you off. Go ahead.
Oh, I was going to say, I was just going to mention briefly that my oldest daughter, after she graduated from Texas A&M, she went to work for UT Arlington for about a year and a half. So anyway, I'm a little bit familiar with UTA.
Oh,
Well, that's great. You're kindred spirit.
That's right.
Yeah.
And one thing I do want to mention, Kevin, is that this is part of one of our newer initiatives that Dr. Bill Seeger is spearheading at this time through the UTA College of Business. We've launched the UTA Corporate Education Initiative that is going to basically provide tailored and open program classes as well as resources like this webinar series to industry folks out there that are looking for professional development in various forms of, everything for accountants, offering CPE credit hours to leadership development classes, venturing even into healthcare management type topics. But, we, as I mentioned, launching this new webinar series, we couldn't be more delighted to have you as our first guest. I know we weren't able to get you on video, and I know you're in your suit. I saw you earlier on video, and we couldn't patch you through here, but I think being able to provide your expertise has been absolutely of great value, as I mentioned earlier. One thing I do want to share, and Bill, you'll have to confirm to make sure everything is technically working okay. When I pull this up, can we start our webinar series, Bill, on your screen?
Yeah. What do you want? You want me to share a screen, or do you?
No, I have a screen share. I'm just making sure you could see it.
No, I don't see it.
Okay, well, that's fine. Just letting everyone know that moving forward after Kevin Kliesen today, obviously, with speaking about the Federal Reserve response. Tomorrow we continue with Dr. Tracy Freeling, excuse me. She's our Associate Professor of Marketing with the UTA College of Business, and that will be at 11 a.m. Central Standard Time. She'll be discussing her recent research and articles in COVID-19 and anecdotal bias. When poignant stories outweigh cold hard facts. And that continues on into next week when we are talking about cybersecurity threats and economic outlook in 2020 with a macroeconomic perspective. And then we will be kind of rounding off the tail end of our webinar series with Dr. Amy Cruz-Cutts, who is the President and Chief Economist at AC Cutts and Associates, speaking about consumer finance and portfolio planning on the 26th of May. And on the 27th of May, we will have Dr. Edmund Prater as a guest speaker, who's our Executive Director of the UTA Veterans Outreach Center and Professor of Business. He will be discussing supply chain and international trade disruptions from COVID-19. So a great series coming up, but as I said, I don't want to take any highlight away from the fact that Kevin was with us today and was able to share such great information about the Federal Reserve response. So we really appreciate it, and I'm going to make sure that Bill's up on screen again too, because obviously he's moderated today's webinar, and make sure that he can say his thanks.
We did get a question about modern money theory and Kevin's opinion of it.
Okay. Kevin, before we let you go, a great question came in, specifically modern monetary theory in your opinion.
Well, as I understand it, there's kind of various flavors of MMT or modern monetary theory. I think I haven't studied it in depth, but essentially, I think it boils down to the fact that they would say as long as you can issue debt in your own currency, that you basically don't have to concern yourself with any sort of fiscal cost of rising debt or deficits. Now, obviously, history would suggest that, as we talked about earlier, that you do and you can run an inflation risk when you run this policy. So I think though adherents of MMT would recognize that, I think that they probably downplay it. So I'm more in the Milton Friedman school of things, that at some point rising debt and higher deficits could increase the risk of higher inflation. But certainly, right as we stand right now, that doesn't seem to be the case. So we'll just have to wait and see.
Great. Well, Kevin, echoing Mike's comments, thank you so much. We've all enjoyed it. Thank you to our pardon me. Thank you to our listeners. And we will talk to you again soon, Kevin. Thanks again.
All right. You're welcome. Thanks, Bill. Thanks, Mike.
Yeah.
All right. Thank you, Kevin. Appreciate it.
Thanks, everyone. Bye-bye.